Tim McClone, your $20 million broker. In today's video, we're going to get into the power of pricing power, and also going to include two free stock picks. Pricing power is your ability to raise your prices over time. The less value you capture, the greater your pricing power. Pretty simple, right? So it's related to the economic concept of price elasticity. How sensitive are your customers to price variations? Pricing power is highly prized on Wall Street. Investors like businesses that can pass on those lovely costs to consumers. A growing number of companies are raising prices as costs for labor and raw materials rise, often with no ill effects. So pricing power is important because, raising your prices allows you to overcome the adverse effects of inflation and those increased costs. So I've talked about this historically. Currency issues by any governments tend to decrease in value. There are many strong incentives for officials to increase the supply of currency, which debases the value of the currency over time. So pricing power, more than ever, pricing power will become increasingly important in the face of continued inflation that all companies are seeing right now, and those cost pressures that you have. So as a result, it takes more currency to purchase the same products and services necessary to stay in business and, increasing your business's sufficiency needs. So without adequate pricing power, your business may not be able to remain sufficient in the face of higher expenses that you will definitely incur. So, the higher price, higher price that you can command as a business, the more reliability you'll be able to maintain profit sufficiency. So if you have a choice, choose a market in which you have pricing power. More important than anything right now, it'd be much easier to maintain sufficiency over an extended period of time. And when we talk about pricing elasticity of demand, what does it measure? What does it look at? It's pretty simple. Pricing elasticity is a measure of how sensitive your customers are to variations in the price of or demand for your products. So in other words, price elasticity, it quantifies how much the demand for a product changes when the price is either increased or decreased. So you can take a look how you calculate the price elasticity. To calculate price elasticity of demand, you divide the percentage of change in demand by the percentage change in the price. So, when we talk about, we've talked about this ad nauseum. A lot of people have talked about inflation. This just ties into everything. So inflation, and I've talked about this, is running at 4-decade highs, affecting businesses' input costs. Investors will want to own those companies that can pass along that inflation. Those are the companies you need to be looking at right now. The new inflation dynamic comes just as economic expansion is waning, suggesting slower GDP growth ahead. Stocks of companies that can maintain and increase their profit margins in 2022 should be in demand. So we talk about the U.S. consumer prices soared 8.5% in March from a year earlier for the fastest annual pace since 1981. So a few nuggets from the Labor Department. I pulled some of this data just to, I think it's important to cover these three pearls. Gasoline prices skyrocketed 48%, accounting for half of the monthly increase. Fruity Pebbles are the new reserve currency because cereal prices jumped 9.2%. Meat prices spiked even more at 14.8%. Just in time for wedding season, prices for men's jackets, suits, and costs were up 14.5% from the year, and airline fares gained 10.7% in just the last month alone. So, get ready. So the overall profit margin of the S&P 500 hit a record in 2021, but that's old news. And the current environment is much more challenging right now. A point of differentiation for companies in 2022 will be the ability to keep profit margins intact or growing despite elevated inflation and slowing economic growth. There is real inflation, folks, and there's slowing in the economic growth right now. So, I did a few talks ago on the inverted yield curve, predicting a recession. And I want to dig a little deeper into this because I did some more research. An inverted yield curve doesn't always predict a recession. But the bottom line, in my opinion, the past several yield curve inversions didn't come with this once in a generation inflation. That is the key. It's once in a generation. Now, I did look at another side of this. Another chief economist thinks people get too hung up on the inverted yield curve and don't understand how it exactly works. So I followed this guy, Ken Fisher. Very intelligent man, lays it out methodically, simplistically. He's a billionaire. He's got a different take on the inverted yield curve. So he says he thinks people get too fixated on the yield curve and how the Fed may push short rates above the long rates, making the normal relationship of positive upslope between short rates and long rates reverse, if you understand the yield curve. So the fact that people miss, in his opinion, is that 40 years ago and before, time deposits were the basis for making long-term loans, and they made up 65% of bank deposits. Today, they make up 7% of bank deposits and aren't the basis for making long-term loans. So loans with maturities do that, and those have an average basis points of basically 9 basis points. So the banks have a huge incentive to lend, in his opinion. What people should pay attention to in terms of yield curve is spread between the short term and long term, and not the 2 and 10 year, in his opinion. Okay, so this year the spread is getting wider, not narrower, and there is plenty of room for Fed to raise short rates before you get close to an inversion, in his opinion. So the bank lending is the force behind what is important or not important about the yield curve. So taking in short-term deposits as the basis for making long-term loans. So it's gotten a lot more true in the last 40 years as money markets have become a non-bank system for other people to get higher yields. So it remains true that lending is driven net off the banking system by net outstanding loans, driven by taking in short-term deposits and making long-term loans. That's his take. Something's real in between there. This is once-in-a-lifetime inflation, but that makes sense to me when I delved into the data. So I just want to throw that out there. So companies can achieve pricing power, in several different ways. A business can sell a good or service that's vital to consumers or limited in supply, giving them no option but to pay up. The product has low price elasticity, to put it in economic terms. That could be gasoline at the only station for miles, toilet paper at the grocery store, or accounting services during tax season. So the fewer direct competitors the fewer competitors you have as a company, the greater its ability to set prices. A strong brand that has particular affinity or loyalty from customers can also lend to greater pricing power. So, something to think about if you look at Procter & Gamble, let's take Tide laundry detergent versus equivalent store brands. That's something to think about. So a company can also, innovate and improve its offerings, increasing prices as it rolls out the upgraded offerings. If the price hikes exceed the cost of the improvements, bottom line is that is pricing power. So, it's common in new versions of software, pharmaceuticals and medical devices, semiconductors, and other high-tech goods and services. Companies can expand their profit margins by becoming more efficient and productive. So, or by leveraging, economies of scale. So, that brings down the cost of goods sold per unit produced and increases profits without, raising the prices. So, bottom line, companies with pricing power are particularly attractive for this current environment. So, getting on the phone, talking to the heavy hitters, talking to my investment banker friends, and delving into the pricing models that I looked at and was sent and reviewed, and listening to these calls with these investment bankers, the S&P 500 companies that grew their gross margin revenue minus the cost of goods sold divided by the revenue from 2020 to 2021 as the economy rebounded, but also had rising positive gross margins in at least 3 years before the COVID-19 pandemic. I'm going to give you some pearls here. Those that were best able to demonstrate pricing power in a 2% annual inflation environment should be better set up to do it when inflation is running above 7% right now, and it's double digits, ladies and gentlemen. It is double digits. So the companies must also have been free cash flow positive in 2020 and 2021. Those are the pricing models we looked at, demonstrating their business, resilience through an economic downturn. So I'm just going to give you two stocks that I'm bullish on. Two stocks that I'm bullish on based on those criteria. Merck Pharmaceuticals. It's trading roughly at 86.91, 87 bucks. I don't like this stock because I used to work for the company, folks. But I like this stock. Merck is a healthcare giant that develops and produces innovative, health solutions through its prescription medications. They have animal products, health products, biologic therapeutics, and vaccines internationally. So another key point with Merck is with 74% institutional ownership. Merck is a favorite amongst the big guns right now. And when you look at all those criteria, I think they got an interesting 2022 coming ahead. Institutional investors commonly compare their own returns to the returns of a commonly filed index. So they generally do consider buying larger companies that are included in the relevant benchmark index. So Merck's performance last year was excellent, while the company's outlook for this year appears very promising. They have some new releases. I think it's the mononvir likely to be a sufficient contributor to the future sales. So they have some stuff on the horizon. I like Merck. I bought it 9 months ago. Number two, Hilton Worldwide. It's going about 155, 58. I love staying at Hilton hotels. I'm a Diamond member. The Hilton Worldwide Holdings stock holds buy signals from both short and long-term moving averages, giving a positive forecast for the stock. Also, there is a general buy signal from the relation between the two signals when the short-term average is above the long-term average. So, Hilton Worldwide Holdings was, this is key. Hilton Worldwide Holdings was in 60 hedge funds portfolios by the end of the fourth quarter of 2020. And I bought it at that time in the fourth quarter of 2020. That's an all-time high for the statistic. This statistic of hedge funds. The all-time high is 57. This means the bullish numbers of the hedge fund positions in this stock currently sits at an all-time high. So That's something to think about. All-time high. Hedge fund guys are buying a lot of Hilton. So to bring it all together, uh, something to keep an eye on is, I think, the West needs World War III. They just need it. The real problem here is they went to negative interest rates in 2014 in Europe. And I want to talk, in 2014, Europe went to negative interest rates. They have been unable to stimulate the economy, and Kensington economics have completely failed. I would say this is a mismanagement of government on a global scale. The problem is that the central banks have no control over the economy. Add to this type of inflation is substantially different. And this is what I'm trying to get across. All the readings and people and conference calls I'm listening to. This inflation is substantially different than a speculative boom. This inflation is based upon shortages, printing of money. So what we have with Europe, and this is important, with its negative interest rates, they have wiped out all the pension funds. They need, from the research, they need 8% to break even, not negative rates. There is not a pension fund in Europe that is solvent at this stage of the game. So the European government is collapsing. If they end up defaulting, you are going to have millions of people down there with pitchforks storming the parliament, maybe. That may be extreme, but if you know what's going on in third world countries, and I'm researching this stuff, it's a little scary what's going on in Africa right now. That's what's going on in Europe. So to avoid this, they need a war, some people are saying. The Biden administration, in some people's opinion, have deliberately destroyed the world economy. If there is a war in Europe, the US dollar will get stronger initially, not weaker. And we are not getting back to normal soon, folks. The system is crumbling from within, and it's just like the fall of Rome, basically. So I'm not a doom and gloom person. So remember, you have to tear it down before you build it back better. Think about that. Build back better, you got to tear it down first. Now, this is the talk amongst, this isn't one side. This is Republicans and Democrats are on board with some of this stuff. But when I was doing my research and on some conference calls and listening to what's going on in Europe, remember, Europe was at negative interest rates. They're having major problems over there. So just like I said, that was a red flag for me, and that was concerning. What's going on over there with the interest rates and where they're at with the pension funds and how that could trickle over here, and why war is sometimes good for defense contracts and making money. Remember the Afghan war, how we supplied people to fight the Russians, and Halliburton, all these companies make money, and look over here when all this stuff happened over here. So it's interesting how this all plays out, but those are two stock picks that I threw in there. When you look at the pricing models and the calls, I invested in these two companies and roughly the fourth quarter, 2020. I think they're great companies to look at. All right, I'm off. I got stuck in some meetings here in the States. Had to take care of that. I'm off to Mexico, launch a property and another development we might be working on. Hope everyone has a great week, and be kind, be creative, don't drink, don't smoke, don't do drugs. Stay focused right now. Take care.